My name is Dave Wozniak. And before I started trading floor research, as Steve was saying, I was a portfolio manager with Stifel Financial for over 17 years and have spent a total of about 33 years managing portfolios. First as a financial advisor at AG Edwards in downtown Chicago. And eventually, like I said, made my way over to Stifel Financial as a portfolio manager. Today, I exclusively am Chief Market Strategist of Trading Floor Research. What I'm going to be talking about today is I'm going to be covering a model that I put together that helps me determine the big picture of the market. And the title of today is Technical Analysis Roadmap for the S&P 500. What I'm going to be doing is I'm going to be using time cycle analysis and Fibonacci retracements to explain this model. And what this model is covering is it's showing a complete long-term bull cycle. And the important thing here is the highest probability of where the bear market lows can come in. So the three areas I'm going to really cover are, the first area is why. Why am I doing technical analysis research on the markets? And the biggest reason is, which we're going to cover here in a second, is because of top-down analysis. Then I'm going to cover how I put the model together, and I assembled it again using time cycle analysis and Fibonacci retracements. And finally, I'm going to use the model to determine the most significant probability of where the market can go from here. So the application of the model. So starting right now with top-down analysis, why is this technical analysis necessary? When what I tell my readers of trading floor research about is the next stock opportunity, and I'm viewing a high probability setup and potentially a confirmed buy. So why am I dealing with the markets? The reason is that my analysis has always been top down. And of course, what that means is I start with the market, I move to the industry group, and then I move to the individual stock. As a portfolio manager and also as chief market strategist for trading floor research, I need to start with the market. I then want to make sure that the industry group I'm looking at is in a buy signal and it's ready to start making a move. And finally, I move to the stock level. And again, that totally explains top-down analysis. The biggest reason that I do this type of analysis is, again, a topic I talked about last time was risk management. And a big part of individual stock allocation for me is determined by market strength and market direction. And what that leads me to is how much to allocate in any individual stock. So that's where this analysis is originating from. And what I actually started focusing on a lot for myself, mostly because of my feeling that the market has entered a period that looks more like the 70s. I've spent a lot of time examining charts in the 70s. That means not only the market charts, but also individual stocks and industry groups in the 70s period. And why do I think everything's looking like that? Well, basically because everything that I'm sure everyone is hearing about. High inflationary period explains the 70s, rising commodity prices, the 70s, and especially rising oil prices, very, very much part of the 70s. And so what I want to do is when you get those similarities, I want to really, really focus on that period and make sure I'm prepared for a period that could look very much like this. This is the Dow Jones Industrial Average. And it actually peaked, it's off my chart here, but it actually peaked in 1968. And the final breakdown of this came from 73 to the low in 74. And what you immediately see, especially about the Dow Jones chart, and that's why I'm starting with this one, is really this whole period of the 70s really looked like a time that the market did nothing. When you look at the big picture, it was just a long period of not being able to break this high of just over 1,000. And it just went through this long period of time. And it wasn't until, and again, this I'm looking, all my analysis today is all on monthly charts. These are long-term charts. So every one of the bars in here represent monthly data. This is monthly, high, low, close periods. And what you can see is in 1982, November of 82, we finally broke that 1,067 area, rallied up a little bit, retested, and ran all the way up until August of 1987, leading into this crash. Why is this significant, and why we're going to be talking about this a lot, and why this kicks off this whole exercise is because still to this day, Black Monday itself, the tail end of this crash, was one of the biggest one-day declines we had, down 22.6% in a single day. And that's what ended this whole thing. Before that, again, we topped out in August and started heading lower. Now, here's the whole idea of what I'm getting to on this, is that during this period of time that really did look very, very flat, what you're going to notice, and this is what caught my eye as I was looking at this, and this is what kicked off everything that I'm going to tell you about today, is during this period of time, it's pretty obvious that we hit an actual low in the latter parts of 1974. And if you put this all together, from 74 to August of 87, this was a bull market cycle. So let's move ahead here. What this led me to is this assembling then of a model using cycle analysis to try to see if this was actually, maybe my eye was seeing it, but maybe was this a reoccurring cycle? Now, what I actually used for my analysis was the S&P 500. What you're going to notice, the big difference between the S&P 500 and the Dow now is the fact that actually the S&P 500 was showing more relative strength in the early part of the 80s. If you look on a monthly basis, the S&P actually broke in 1980 and then came back in 82 and really formed, if you can see this, a very nice cup and handle pattern before it broke out and again ended at the same time on a monthly basis, hit its high in August of 1987. So here's what I'm focusing on during this, the bottom part of this cup. Again, we hit a low in October of 1974. That low was at 62.28. From there, we rallied all the way up to a high of 337.89 on August 1987. What this time period was from October to August of 87, if you measure that out in months, that was 155 months, just shy of 13 years, 155 months. Very interesting. After that 155 months, and you're going to find out why I just said very interesting, because after that 155 months, what happened? We topped out, and within 3 months, we were crashing. But here's the part of it where I use more Fibonacci number. And actually what I did in this case, what I'll do a lot in forming bases and also when I'm trying to get parameters of how far things retrace, a lot of times what I like to use is 1/8. I will break my chart up into an eighth. And that's exactly what I did from the low all the way to the high. I broke the chart up in an eighth. And what you're going to see is actually where we went to, every in-between point of an eighth is a minor extension. And what we actually did was we went to the minor extension of a half. This doesn't surprise me because a half in terms of the eighth numbers is one of the strongest numbers out there. It is so strong that this is what divides the difference between the bulls and bears taking control of an entire time period. So my argument would be the bulls held in there because we did not close below 50% of the range, but we got very, very close to it. Now, this is important as we move through this analysis, though. So we had this bull cycle, 155 months, and we had a massive bear market that ended very, very quickly in this particular case, ended very close to a 50% retracement. What I mean by 50%, that doesn't mean 50% down. It means we took back 50% of the low of the bull to the high of the bull. All right, we took back about 50%. Let's move on. Now, this is something I talked about in my last webinar, and it was so significant in 1987, exactly what I explained to you earlier, the significance of this, that what I actually did a long, long time ago in my career is I established Fibonacci expansions based on that August high to the October low. And I started drawing Fibonacci expansions from that area. And these expansions helped me explain highs and lows of this market every step of the way. This was the 2000 high. The tech wreck came down, tested the Fibonacci area, rallied back up just before the housing and the financial crisis to the top of that range again, came down, tested again the Fibonacci number, came up, hit the minor extension, hit the number, blew through it, rested on the minor extension. You can see how this thing just goes amazing. Finally, this was the top in January. And what's interesting is the minor extension between this Fibonacci expansion and this Fibonacci expansion is 4830.88. The actual high number missed it by less than a point in January. We then began this decline. Now, if you were reading my newsletter, I kept pointing to 3742, 3742. Why was I pointing to 3742? Because it simply was a major number on my Fibonacci expansion. And sure enough, that's where the bounce happened. We'll get back to that later. But I just wanted to outline this in saying how much I put into this crash, again, because it was one of the most dramatic crashes we've actually seen in the market, and that's bigger than 1929. I mean, 1 day time period in Monday alone was 22.6%. Between Friday and Monday, this was a major, major clipping of the market, okay? So here we are back again. Now, I said I established this first period as a 155-month period between October 74 and August of 1987. Then we bottomed in October of 1987. What I did from that point was, because my eye was seeing this and I wanted to verify this with actual time cycle analysis. So what I did was I measured exactly 155 months from the October low all the way into the high. And actually where it came to was it came to August of 2000, not March of 2000, which I find very interesting because if you can see on this chart, the actual monthly closing high actually turned out to be August of 2000. And by the way, that's when the major drop also started to happen. So it's very interesting that 155 months took us right to that August high. Now, the rest of it is, and again, this is where we run into the predictive part of this model, is again, after the 155-month bull market or bull cycle, we then started to sell off. I put my eighth numbers in there again. I divided this up into eighths. Sure enough, where did we go? We went to the minor extension of a half. We got down to the half range. And again, half doesn't mean 50%, doesn't mean 50% decline. It means from the low of 1987 to the high of 2000, the pulled back at 50% of that range. We then proceeded to rally. What's interesting about this rally, though, is although we peaked our head a little bit above, again, notice your monthly chart. We never got a monthly close above the March close, the March high of 2000. And what happened? The bear market continued. Now, this time, the financial crisis took us down, and this is very important, took us down to 2/3 of the range from the high to the low. We actually went on March 2009, we went down to 2/3. And again, this is building all of our model to explain where we are today. 155 months, this was down 50%, 50%, and 2/3. Let's move on. Once we hit that low of March 2009, and we began to rally, again, I wanted to take my 155-month bull cycle, exact bull cycle, from the March 2009 low, 155 months later, took me exactly to January of 2022, the exact high month of the market. Now, here's where I think it gets really interesting, because now, if these cycles explained bull cycles in the past, and each one of those had a certain degree of retracement from those major bull cycles, I would anticipate the same type of retracement in this bull cycle. What's interesting is I took and divided this chart again into eighths. And what you're going to find here is we went down to a quarter. Now, a quarter is a decent, it's a strong number, not nearly as strong as a half, but it is a strong number. It, again, makes sense why we would bounce at that point. And again, it also correlates with my big Fibonacci expansion chart of 3742. This one is at 3780. And by the way, this little blip down here, we only lasted 2 days below that number before we started to rally, which also was very similar to the COVID. And I pointed this out in my newsletter too, in saying, get ready, we could have a nice rally that comes off of that. And sure enough, that's what's happening right now. I pointed out, I used the same exact idea at the COVID low. We spent 2 days below my important number on the COVID low before we started to rally, my big number. And then we started to rally off the COVID low. We did the same, it was identical. We did the same pattern setup again. So it does not surprise me that we are in a rally mode right now. And we're going to talk about, this is in the final stage, what I'm going to talk about here is where this rally goes to. But now, after the rally, what we need to talk about is, let's look at the predictiveness of this. So again, 50% of the range from the low to the high gets us to 2742. If we go down to the financial crisis low, that could get us as low as 2252. These are my ultimate targets for the bear market. And that's what I'm looking for. Now let's put this together and put together a technical roadmap. So here we are back on the long-term S&P 500 chart again, starting in 1987. One thing you're going to notice about this too, which I always try to do, we're not going to go into Elliott wave, but it always is a nice little Elliott wave. 1, 2, 3, 4, and of course 5 finishes us off on the Elliott wave. What I was also able to do is, I love doing this on charts too, to get a predictive idea where price can take me. I always will take significant highs and draw a trend line over those significant highs. What happened here after the COVID low, and again, here was my big number, 2395 on my long-term Fibonacci expansion chart. Spent 2 days below that number, popped up, it was buy time. Now, the big thing that happened during this period, though, of course, that drove us up was the Fed was pumping tremendous amounts of liquidity into this market. A lot of this, I do believe, was synthetic. As a matter of fact, logic of technical analysis would have told me that we probably should have peaked out in this area. And most charts, you're going to see that you will peak out throwing into that top line of the trend line. Most of your most bullish charts will do that. And that's very rhythmic to see that. The one thing I'm going to tell you is, when you do break that kind of a trend line to the upside, what will happen 9.9 times out of 10 is a parabolic move. And that's exactly what we did. And it was such a parabolic move, it blew through this Fibonacci number, this expansion number, like it wasn't even there. And again, I've seen too many charts. I look at way too many charts to know that when you get a significant trend line butting up against a major Fibonacci number, this market should have actually topped in this range. And then we should have had a correction. But again, with all of that stimulus pouring in, this market, once it broke, it went parabolic, okay? Rallied up to the minor extension between these two numbers instead. So still, this was very explanatory, and we rallied, like I said, less than a point away from, the top was less than a point away from my minor extension. But here's what's interesting. Again, when we started to make this decline, we actually, a very significant thing happened. Not only did we hit this major Fibonacci number of mine to get us up for a bounce, we also hit the very significant trend line at the very same time. This is what created that high probability trade, and I believe gave us this momentum move that we're seeing right now. So as I see this right now, here's one thing I want to say as we look at this chart. 4299.64, we're just going to call that 4300 so you can easily remember this. 4300 is the 1/8 number on my whole grid. And the whole thing about using my eighth numbers is the understanding, again, of the strength of every one of these numbers. Again, half is the strongest. A quarter is very strong. The thing about an eighth number is an eighth is the weakest number of all of them. eighth and 7/8 down at the bottom. They are both the weakest numbers of the whole grid. And why that's significant is if, and again, this is where I'm not trying to be Nostradamus here and predict the market. What I use this for, and it works very effectively, is what I use this for is to know what to do when the market does something. And because of these different numbers, it appears that I know what the market is going to do, but I don't. I deal in a world of probabilities. And what I know about an eighth is if we rally now up to 4,300 and we hit that number like a brick wall, this is what could lead to a crash situation. I'm not saying it will. I'm just preparing you that know what could happen if we rally to 4,300 and the market starts to move away very quickly. That could lead to a crash scenario. That I'm just prepared for. I'm not saying it could happen. We've already blown through my minor extension of 40-40. And the next minor extension above this is the 100% minor extension, which is 44.59. These are very big target areas to be watching for, okay? Now, let's, okay. So now, again, I've just kind of blew this up a little bit further here. Same type of thing I was looking for. But what I want to bring out on this chart is, and again, here's these numbers I was looking for. Here's that 4,300 possibly right here. And once we hit wherever we're going to go in this, and we do reverse, the key things to watch for are, number one of the big things that I would watch for is if we end up closing below this 37.42 number. That will make it very conclusive to me that this market is then going down to these levels that I pointed out. We would be looking at 27.42. Here is my big Fibonacci number between the two numbers of 23.95 or the 2/3 number of 22.52. These are my target areas right here. One thing I want to point out as we're looking at this too, remember I said, you know, that all the Fed intervention came in from COVID and synthetically pumped this market up. Now that the Fed is reducing the balance sheet, starting to sell the bonds, starting to pull it out of the position, now we're taking liquidity out of the market. What's interesting is, isn't it interesting that this target area basically gets you back down to the COVID crash area again? I find that kind of on a fundamental standpoint, it sort of makes you want to look in that area. And that's exactly the area where the target numbers take you down to also. So finally here, what I want to point out is this. My short-term fib targets. What's really interesting today was a pretty exciting day, but I want to point this out to you right now. This was a big number I was looking at for a while now. 4227.75. Why is that a big number? If you go from the high of the market in January to the low of the market in June, this is 50% of the range. Right now, the bears are still in control of this market. A close above 42.27 will officially put the bulls in control. I don't know if you saw where we closed today. We closed at 42.10 with a high of 42.11. This is going to be very, very significant. And I'm going to tell you, when you get to a significant number like this, and especially when the market is short-term overbought, this is going to be very tough to take out on a first round, no matter what. And so I would watch this number very, very closly in the short term. What's interesting is from my first high to my first low, I teach this in my class. That's how I build my Fibonacci expansion numbers. And the 2.618 expansion number from the first high to low gets me, does that sound familiar again? 4308, right in that 4300 area. And by the way, what does it also do? A lot of market rhythm here. It also takes you up to the declining trend line of the market. These two numbers are very significant numbers for me as we make our way. This is the area where I felt the market rally would probably terminate. Now, if it doesn't, and again, this is all the things you got to play for. If we break this area, this market's going to have more legs in it before it actually does come around and reverse back down again. Ultimately, if the big picture plays out, this market is going to have to, again, based on the 155-month cycle and the retracements of the past, the market is going to have to end at those locations. The whole idea now was measuring the move of this market rally. And these were the most likely targets I had on this market rally. Let's see how it plays out. But that's pretty much what I had for you. Again, here's the full picture of the cycle again. As we look at it, here's 50%, here's 2/3. And I also just kind of showed you the projections again. Here's the numbers that I'm looking at for the downside. And that's pretty much all I had for you today.